Now, one morning I woke up and said, you know what? I'm buying a new car. Nissan X-Trail 2024, clean, powerful engine. I like Nissan. Then I saw the ad, only $350 a month. I said, hey, that's doable. But when I opened the finance agreement, the total cost was way more than I expected. That's the trap. We fall in love with the monthly number and ignore the real maths. And that sudden feeling of you going out with a nice shiny object and you be like, they're gonna see me, is exactly what puts you in the predicament that 80% of people in car debts are actually facing. Now today I'm breaking it down. Car finance, interest, APR, no jargon, just facts. Now let's start simple. What is interest? Now interest is rent. You are renting money from the bank. So as an example, if the car costs, let's say £20,000 and the interest rate is 10%, you are paying an extra $2,000 just to borrow. So instead of $20,000, you're really paying $22,000. I guess that's clear. Now the higher the interest rate, the more expensive the car or the rental fee becomes. It seems simple, right? But wait a minute, there is more. Now, have you ever seen something written APR, or the abbreviations APR, which is annual percentage rate? Is the interest rate, is the real bill plus all the sneaky fees, admin, lender charges, arrangement costs. So the dealer says 8% interest, but they add $1,000 in fees. So your APR might jump to 12% or more from 8%. That's why APR is always higher than the interest rate, because they have added sneaky fees inside. So don't just ask for the interest rate, ask for the APR, because that is the truth. Now let's break it down with real examples, right? Now let's say the car price is $20,000, deposit is $2,000, and the loan is $18,000, and the dealer says just $350 a month for 5 years. 350 times 60 months equals 21,000. Are you seeing the maths? Now you add your 2,000 deposit already, because usually when you get into the car dealership, you've got to be holding something for them to trust you with their cars, right? So 2,000 plus 21,000, that's 23,000. So for a car that costs 20,000, you end up paying 23,000. Now that's 3,000 extra just for borrowing money. That's APR in action. Now imagine doing that for 3 cars in 10 years, and that's nearly 10,000 gone. Now, do you know that 2 people can walk in and look at the same car, same time, same country, same currency, but with different amounts to pay? One, obviously everyone has a credit score. Now if you have a higher score, it means you may get it at a lower APR. That means some can get like 6% APR, which is good for them. But if you have a low score, you could be paying around 25%. I don't want to rub it into you, but just imagine that. It means if you get into a car loan debt and you're not prepared and you don't have a credible credit history, that means you're going to be paying more than just Mr. Tom, who's been here 25 years, or Mr. Tom, who's been here all his life. Now if you have a low cost, that means you're just going to be suffering with that debt. The other thing that makes people maybe pay differently is that the long term. Some people would prefer to pay a large amount in a shorter period of time. That could actually lower your APR rate, or you get lower rates in 3 years than in 5 years. Number 3, if you put a bigger deposit, it means less borrowing and less interest overall. So some people who are financially stable would actually go with 10,000, and that means lower APR costs. Number 4, you have to understand that the car type also contributes. If you are buying a brand new car, you often have a better APR than a second-hand. Why? Because a second-hand car is not really reliable. Some people are quite afraid of giving you back probably your equity, or actually giving you another car, because they're afraid that anything could be wrong, because these cars have been driven before. Number 5, banks, dealers, online lenders they offer different deals. It's just a market whereby you are arranging and negotiating. Anyone can actually bring you a different deal. So same car, same country, different maths. It's just a total mess. But let me be real with you. Many of us in the UK are stuck in car finance traps. We see 350 a month and we say, oh, I can afford it, but we don't really check the total repayment. By the time the car is paid off, you spent thousands extra. Money could have been deposited for a house. I'm just gonna be factual with you. The amount of money that you're already paying to cover all that can actually go towards a lifelong investment for your children. If you don't have children, probably for yourself as well, because you still have a long life to live. And here is the kicker. Now, a car drops value in a year, a house goes up. Don't let a shiny car block your future wealth. I'm just being frank, and probably I'm just trying to encourage you to do better. Now, let's try to flip the script, because most of you would say, so what do you suggest, Mr. Investor? Forgive me. Now, what if instead of buying that car, you invested that 20,000 pounds in the S&P 500? Because let's be fair, if 20,000 pounds can be paid in a period of 5 years, why not just put it in a compounding and an account with interest? I'm just asking myself. So you know that if you're investing, you have to understand that there is something called the S&P 500. It's top 500 companies in America, and these companies have actually shown a steady growth over the past, I don't know how many years. So most people who have invested their money in these companies have always had a benefit out of it. So over the past 5 years, S&P 500 returned 117.1%. Imagine that rate of return to your money. So let's say one is called Sophia, the other one is called Mary. Now Sophia decided to go for a car finance company that made her pay 20,000 in a course of 5 years. In fact, 23,000 because the interest rates, right? And then let's say then Mary decided to say, okay, instead of what Sophia is doing, every month she's paying 350 until 60 months to pay off the car loan debt. I'm going to direct the same amount of money, same time, same month, every month, the same day, towards investing in S&P 500. That means, if we're doing the maths, 20,000 pounds would have grown on Mary's side by 117.1%. That becomes close to 43,420. That's again maybe 23,400 something more to buy a second car and pay off the debt, yet she's still keeping the money. I don't know if it makes sense. So you can even boost your house deposit by that amount of money. So while your car dropped in value, Mary's investment was growing value. So sometimes the smartest flex is investing in your future. So next time you see a 350 a month, just pause a minute and ask, what's the total payment or repayment? What's the APR? What else could I do with this money? Because if you don't understand those numbers, you're not buying a car, you're just buying a financial headache. Let's be wise. Let's stop being excited by monthly payments and start calculating the real cost. Don't buy the monthly payments, buy the maths. Now, that's it.